should pay yourself. I mean, every week you should at least have something in. So you just work for free right now because this is like
Yeah.
a job, kind of sort of, but you're not getting paid.
Well, I win some and lose some, so
Mm-hmm.
it's kind of flat.
Yeah. Okay. Well, we can change that. We can change that. A good motivation I have found is that once you've discovered that once you gain some consistency, no matter how small it is, right? Uh, you set a target and say that once I reach a certain dollar amount, dollar figure in the account, then you're going to start paying yourself half of the profits every time you trade. That way, half is going into the portfolio growth. The other half is uh, going into you're paying yourself. That way there's a motivation because I do understand you're going to lose and gain, but you need that small step of just feeling that at least I paid myself a couple $100 last week or something like that, right? And that gives you
Yeah.
motivation to keep going. So if you're not paying yourself, then it's going to demoralize you more than encourage you. Yeah. So just make a goal, make a habit. Personally, I pay myself, $1,000 a week, uh, which is not much, I think, but based on how I trade, I think that's comfortable. What stays in my account is a whole lot more. But $1,000 a week is that covers my golf game and a few other things.
Okay.
So yeah, maybe some groceries. I have very low expenses. But the reason I do that is just so that, on the days that I lose, then I pat myself on the back and say, yeah, you collected a grand or 2 grand, whatever, it's in the bank. Don't worry about it, right? That way I'm not even losing what I should have paid myself.
Mhm.
So that's how I work. So let's see today's topic. I had a few things that I wanted to talk about and then just keep it nice and short. But let's see, maybe we can take some questions first, some burning questions first, and then get into it. So who's got something they want to share? Either an experience, something that's going on, uh, big question in their trading journey, anything. What's up? Rakinet says she's listening while walking. Okay, that's cool. That's cool. All right. Well, I'll keep it short and nice today then. So this is geared to people who've been, maybe trading for a while, and uh, it's kind of gotten mundane. They're kind of like inside of what do you call it? That wheel that what's that animal that spins the wheel? I don't know. Some rodent goes around the wheel without going anywhere. I don't remember what it's called. But anyway, yes,
Hamster.
the something star, right?
Hamster. Hamster.
Hamster, right? Yeah, the hamster. So you feel like a hamster in a wheel, and you're not going anywhere. So some of the symptoms I've found for a lot of people who've been in the game, but they, they're experiencing burnout. uh, what I encourage you is to check whether you have some habits that are holding you back, some undesirable habits, so to speak. So I'm sharing a small slide over here. Let's go ahead and make these about 175 so you can see it a bit better. Uh, but some of the things that I found, and this is from even personal experience, is trading too close to the market open. Is anyone familiar with that? market, you've been dreaming about the market, and as soon as 9:30 hits, you're in there, you look at two, three things, and you decide that you have absolute confidence, you have knowledge, and you make a trade. Anybody have that idea? Anybody been there? Yeah, you've been there before, right?
Yeah.
So, uh, let's see. Yep. So that is something that you want to watch out for. There are very, very few situations where you want to make or place a trade right at the market open. Number one is maybe stock ran up overnight, and in the morning, once the options market opens at 9:30, you want to take your profit and run like a bandit. That's scenario number one. Scenario number two is something else happened overnight. You believe that you're in a position that is going to be losing heavily. Well, the best time to get out is in the morning. Don't wait for it to try and come back up. No, just rip the bandit out in the morning. That's the best time because you have the highest premium at that time. Uh, it also depends on the type of trade. If it was a credit spread, then it might be you rolled it from the previous day or previous session. So those are the few scenarios that you want to trade as soon as the market opens. And there's very few of those. Another one is maybe not setting stop losses, right? So we know that stop losses really should not be optional. They should not be optional. These are things that are part of risk management that ought to help you not lose money. So your biggest business as the CEO of your trading company, because that's who you are, all of you are CEOs of your trading company. Your job is to manage risk. It's not necessarily just to make profits for you incorporated. No, it's your biggest job, bigger than making money, is managing risk. Risk means that you're not losing more than you can possibly gain. So let's say you have a small account. I'm going to call small account, say $5,000, and you're trading, $500 or something like that. Your potential profit is for $500. You have no business losing more than $500 in a transaction, right? So you want to, ensure that you have those stop losses or you have controls in place that will help you out. And that's one of the things that you can do automatically uh, without feeling any pain, right? If you set it up as a rule, for example, you set up a bracket order, then it's automatic. You're releasing control to the system, which is actually a good thing because if you depend on yourself and they call it a mentor stop, well, guess what? You're human, right? And mentor stops are the same things that are going to tell you that there's a likelihood that it's going to turn around, or it looks like it's been you hit that level and then bounce back. I'm going to wait again. Tell you what, those are not good situations. Instead, what you want is to trade objectively, remove that subjective emotional aspect and just trade mechanically. Those are the times that I have found that I have been very, very successful when I didn't have to make a decision about whether to get in or out and let the system do it for me based on the conditions or the rules that I have set. My winning has gone up, and I don't have to stress. It also means that I don't necessarily have to be in front of the computer to make a decision. So set your bracket orders or set your stop losses appropriately. You take profit, don't be too greedy. Understand how much the potential is for each trade. Remember, each trade has its own merit. So even if you have, say, a goal of making $500 per trade, it doesn't mean that every trade is going to give you $500, right? Sometimes that trade does not even have any potential for giving you 500. Maybe it gives you 200. So don't go looking for 500, knowing full well based on the calculations that the possibilities, the higher probabilities for something like 200. Yeah. So plan your trade accordingly. And again, we can help you, manage those, show you how to do that effectively. One of the things, this is the next point over here, the huge position sizes. If you've been trading a while and you've got this one strategy or two strategies that, you know them like the back of your hand, and you're like, yeah, I know how to do this. I'm just going to go in and, do 5, 10 contracts. Uh, Sometimes that will come back to hurt you because guess what? Your position size is probably one of the biggest factors in how that trade goes when it's not doing well. It's a great thing to have a huge position size when the trade is going well and you're able to manage those profits. But it's a very, very difficult time when you have a huge position, maybe sometimes even larger than you normally trade. Maybe you are extra confident in something. Um, that position size can come to be, your downfall, right? And especially in some of the higher probability and higher risk uh, strategies. And talking about credit spreads or iron flies, they're higher probability, but they also have higher risk, right? So you need to manage them well. Position sizes. A good rule of thumb is to trade about 1 to 3%. And I have a slide here that I'm going to show. What's a good size amount to trade inside of your account. So when you think about what 1 to 3% of an account is, obviously, that's for a large account, but for a small account, that 1 to 3% might have to be more like 10% or 20%. So we talked about $5,000 account. If I want to say trade, I don't know, 20%, that would be $1,000. That's very, very high uh, scenario. I would say that regardless of whether you have a small account or a big account, you should never trade more than 20% in one position. The bigger your account, the smaller that percentage should be. So just to give you an idea, if you had, say, $100,000 inside of your account, 20% is actually 20,000. You don't want to be in a $20,000 account position. You more likely want to be something around, 1 or 2%. So the larger your portfolio, the smaller the percentage. And we'll talk about that a bit later. Do you have any questions based on that? See if there's anything in the chat here. Nope. Okay, cool. Let's see. Ignoring the trend. Yeah. Ignoring the trend means that you did not look at the chart, or you looked at it, you saw it, and you have something set in your mind that today I just know this symbol is going to go up, or I just know this symbol is going to go down. Well, you don't. You may be right some of the time, but really what you need to do is identify the trend, confirm the trend, and then trade defensively. Yeah, just like we're taught to drive defensively, you also need to trade defensively. So there is such a thing as trading defensively. Don't ignore the trend. If the market is going up, or your symbol is going up, or that sector is going up, you shouldn't be in a business where the strategy you're playing is going down or is built for a downtrend. You get the idea. Listen to your broke brother-in-law, sister-in-law, friend, neighbor. Listening to your dog, your cat, whoever you listen to. Make sure that whoever you're listening to is sound, right? Make sure that they're either teaching you, they're holding your hand, they're successful themselves, they know what they're talking about, and they can walk you through. It is different from going on to some internet website, signing up for trades and all of that, and nobody's talking to you. They're just telling you, go ahead and trade this symbol XYZ. We have an inside, tip that is going to go up in the next few hours. So go ahead and buy or go ahead and sell or something like that. Yeah, that's what I mean by listening to your broke brother-in-law. That broke brother-in-law, substitute that with, you know, uh, all the noise. You're in some Telegram group, you're in some Discord, you're in some WhatsApp group. There's so many groups out there these days. Everybody has something. So just make sure that if you're going to listen to them, make sure that it's solid. You trust them. You have there's past performance to support what they're saying. Yeah, and also don't just blindly, even if you're listening to them and they're experienced. There are times that somebody might be in there with malicious intention. Yeah, I've seen that before. Been a member of a group where somebody was just letting some information out which they purposely knew was not true. It was incorrect. But some of the gullible members are like, yeah, we'll take this. We think that this is true, and they act on that information. So be sure that you're able to understand before you act on anything. Make sure that you're able to you fully make sure you fully understand what that person is saying or that advice that is being offered is all about. Don't just blindly take it. Let's see. Journaling. These maybe you guys can tell me how do you guys track your trades? Who tracks their trades? Who does not track their trades? You should all be tracking or keeping a journal of your trades. So the the deal here is that what is not measured or tracked uh, cannot be improved, right? So if you're not, you know, if you can't figure out where you were on Monday and where you are on Friday and see the difference, uh, or understand which strategies are working for you, then it means that you're not measuring your own performance. I don't know any job that you can go to where they do not measure your performance. Anybody have an idea of any job where they don't measure your performance? Right? It should be standard. It's pretty common. If you get hired every so often, hopefully, your boss is going to have a one-on-one with you every month or every couple of weeks. Yeah, I think that might be too much. Maybe every month, every quarter, or at least every once a year minimum, just so that they can have a basis for giving you a merit increase. A lot of you are employed. So what's happening in that scenario is that they're measuring and they're keeping track of your performance. And so when you sit down with them, they're telling you, or you're telling your boss what you did, what challenges you heard, you encountered, what you're working on, your growth plan, what you're trying to do, um, how you're helping improve the bottom line. Basically, it's the same thing. Don't forget that. So carry these from your corporate job or from your current job into your trading job, because this is your trading career. I mean, heck, I even grade the guy who mows my lawn, right? I'll walk out and take a look. Pretty sure all of you do. That's measuring. And if you don't like what you're seeing, what are you gonna do? You're gonna talk to him or her, and you're gonna offer tips and comments and say, could you trim around these bushes a little more, a little higher, a little lower, whatever. You're giving feedback. You're making changes. That's what's going on. It's not a bad thing. You're just offering constructive feedback. So you need to be able to give yourself constructive feedback. You need to be able to recognize that I've just been doing these calls and puts, they're not cutting it. I'm either going in too close, I'm going in, way out of the money. It's not working. You start measuring. Get somebody to look at your trades. By the way, yeah, there's a thought. Get somebody to look at your trades and tell you, how you're doing. Get an objective, uh, get an objective eye. So here's my offer to you. If you want, I will for 20 minutes look at your trades for the last 2 months, and it's very easy to do that because Thinkorswim keeps a history of everything. So I can tell you by looking at your, what is it called? Now, if I go to the monitor tab and I go to your account statement, I'm able to pull in, or you are able to pull in um, your activity and all of that stuff, and we can see in absolute detail what's been happening, what time you're trading, all of that good stuff. I'd be happy to offer a free 20-minute analysis of your trades, and let's just see what's working, what's not working. That's an easy way to do it. Let's see what kind of questions you guys have so far. See, let's welcome Barbara. She just joined. Uh,
Eddie, what do you use for a trade plan? Do you track it in an Excel spreadsheet? Do you write it out? And then what do you capture?
Okay, I capture, so I do have a spreadsheet that I capture all my trades. Thinkorswim does a pretty good job of obviously journaling everything that's happening. I'm now 100% with Schwab. Previously, it was TD Ameritrade and Schwab. Schwab also have the same thing. So with Schwab, I have a portfolio performance where I am able to go, well, I'm a junkie for trading, so I'm there every day. I can see what's happening and I keep track. So, for instance, I've been keeping track of performance on my account since I moved 100% over to Schwab. And I've been checking to see which trades are performing better. So, I've got several accounts. One of them is rocking about 32% profit in just 1 month. 32%. This is a large account. Uh, and I'm just thrilled by that. Another one is it's also a large account, but it's only doing about 3%, right? I checked this morning, it was about 3.27%. One of the reasons I can attribute to why it's so low compared to the 30% is because for me, it's somewhat difficult to trade two or three accounts at the same time. So what I'll do is 1 week I'll trade this one account A, and then the next week I'll trade account B. But I also have this one account that I have to almost trade every day because it's the one that pays my bills. So the one that has a lower percentage, uh, I reviewed that, and when I saw the 3%, that was again an indication to me that it's not performing well because my target is 5%. To answer your question, what do I use to track? Two things. The platform itself, which gives you great, accurate, unbiased data, and then your spreadsheet, which you can, in a more organized fashion, and one of these days I'll probably share that, a template with that describes what kind of trades I do. I'll give you an example. Last year, I was trading everything, almost, well, not everything, but too many things, too many strategies. I was doing a lot of calls first thing in the morning. I was doing a lot of puts, depending on what direction the market was going. I was trading several instruments. So you all know that I trade S&P 500, the SPX. But I was trading that. I was also trading XSP, which is a smaller version. I was trading SPY, QQQ. I've always loved the Mag 7, so I've always traded, Amazon, Apple, Microsoft, all of those things. And most of those were calls. I also did a combination of debit spreads and credit spreads. But when I analyzed most of my winning trades, I found overwhelmingly, I was getting more and more, I was getting better and better at credit spreads. Now, I've done that for a long time until I got burned for, one time and I kind of got gun shy, but I've come back. So for the last maybe 1 year, I've just been doing spreads, selling premium, and that has been working for me. It's a great way to do it. So that's what the measuring here will help you do. It's going to help you see objectively where are you consistently getting better performance. So that's what's happening for me. Yeah, every day I keep track, and one of the things that helps me keep track is On Thursdays is my payday. Well, my payday is Friday, but Thursdays is when I push send money to bank. Uh, that way it can hit my bank on Friday morning. Because if I send it on Friday, it's going to be there on Monday morning. Well, I need the money like on a weekly basis. That's my goal for that. So I pay myself on Thursday, and that's also one of the reasons why I trade 4 days a week. Because on Thursday, at the end of Thursday, as long as I put in my order to transfer by 5 o'clock, cash is in the bank. As soon as the bank opens the following day, at least my bank. So, and I'll give you another tip. One of the other things that I do when I transfer money to my bank is if I didn't make any money, then it's unlikely that I will pay myself, right? So I almost actually I never, as a matter of principle, draw down my portfolio. So I'll give you elaborate what I mean. Let's say I start off with I'll just say a figure here, $50,000, and at the end of the week I have $55,000. Well, I cannot transfer more than $5,000 because I don't want to go below 50, right? So let's say I transfer $1,000 and now at 54,000, and that's cool because for the week, guess what? I am up about $4,000 and I paid myself $1,000. The following week, 54 is my base. Is that making sense? 54 is my base. So on Monday, 54 is my base. And on Thursday, whatever number I have, then I can transfer some of that, but not go below, I will not let the account go below 54,000. So maybe if the account is at say 57, 58,000, I'll do another 1,000 and be left with say 56,000, right? So those are real numbers. I do that every week. And the reason I do that is so that I can justify why I spend 2 or 3 hours a day doing this. So for me, I totally enjoy it. It's fun. I enjoy just watching my account in the morning on Fridays. Just ooh, look at that! Just got another. Somebody paid me. Well, that was me. I was get a ticket doing that. So yeah, you have to have fun doing that. Does anybody? How do you all track your trades?
I don't track my trades. I
Okay.
have mental notes or sometimes, well, I'll sometimes write in my notes in my phone, but
Mhm.
I don't do a in-depth tracking.
Yeah. And you and I know we have a few meetings set up. We're going to go into that where it will become very, very helpful for you. And I'll teach you how to actually make sense of what you're keeping track of. Because if it has no purpose, really, then you shouldn't be doing it, right?
Yeah.
So we're going to figure that out and also identify how it is going to help you improve. Is one of those things that is immense because here's a scenario. If somebody tells you, man, last month, was terrible, you know, man, the market was just brutal. It was, yeah, I don't know what happened. And you ask them, well, how was the performance? How did your portfolio behave? What what is it that makes you think or believe that the market was brutal, right? Because it sounds like it's a subjective statement. It really should be approached in a way that my portfolio either declined, say 2%, 3%, or improved, 3%, 4%, whatever it is, then you have a basis for saying, or for using the words, the adjectives brutal. Because when you say brutal, it means that your account maybe you went down 10, 15%. That's brutal, right? For a small account. But if you don't even have a journal that can show you by how much it improved or declined, then you have no business of even describing whether it was a great market. A lot of people I talk with these days, they're like, oh man, the market is this and that. Well, Tell me about your portfolio. Let's start there, because if you're trading and you still think the market is, yuck right now, how is that being translated into your own personal portfolio? So we need to do that. If you're keeping track of it, then you can objectively say that either you're flatlining, your account is not growing as healthy as it should, and we can figure out ways to improve that. But if you're not tracking it, then it's really hard to just be objective and say here's where the problem is. Yeah. So I encourage you all to do that. Questions on that? All right, let's move on. A couple other things I had I wanted to talk about. Let's see what time we have. Okay, is how to trade a large account. So this is, believe it or not, this is something that has come up in with a few of my students. They started off with $5,000. They are now rocking $60,000, $70,000, and they have a new problem. I like these kind of problems. So it is not uncommon for people in my circle, students, to grow from, $3,000 to $5,000 all the way to even $100,000. And all of a sudden you're looking at a six-figure account and you have never managed such an account. That's a dangerous thing. So you need to know what to do. So here's what I suggest. If you're trading a large account, I will call a large account an account that has got $50,000 to say $100,000, right? $50,000 to $100,000. If you are keeping more than $100,000 in your account, in your brokerage account, we need to do a few different things. So this one is just for the 50 to 100. There are others who, originally they had some money and they, maybe it's a 401k, a retirement IRA or Roth, whatever. But this is, I'm targeting here folks who are keeping maybe 50 to $100,000. So from my personal experience, I need all that money to give me a weekly paycheck? Let's see what some of those answers would be in the chat. Do I need all that money to give me a weekly paycheck? Let's see what your thoughts are. Where's the chat? The chat box. Somebody type something. All right, somebody says no. No, all right, so nope. That seems to be the common consensus, that you don't need that much money to give you a weekly paycheck. Well, guess how much you need? What is a good number? It all depends on what your goal is, and that goal should be one that is reasonable. So I'll give myself, I'll give you, oh yeah, I'll give myself as an example here. And on a daily basis, I do not spend, or I do not expose more than 20% of my account. 20% of, say, 100,000 is what? $20,000. No, I don't even spend that much. All right, $50,000. 20% of 50,000 is $10,000. Well, guess what? I don't even spend that much every day, but I do go up to 10,000 regularly, right? Not very often, but very, very commonly, I will go 10,000. Maybe if I have 10, 20 spreads or something like that, then I might just do that. But I don't expose myself to more than 20% capital exposure. So I have a lot more in my account, but that's a number that I have designated and said this is how much I want to be exposed. I don't, for any unforeseen reason, whatever, maybe a system crash. I'm unable to get into my accounts. Something happens. We have a black swan day. You're all familiar with a black swan, right? Yeah, black swan day, and market goes crazy, and you're looking at a loss of everything that you touched that day. So $10,000, believe it or not, is enough to give me a daily 10% return. So 10,000 times 10% is about 1,000 every day. That's conservative. That's conservative. To say that I do make $1,000 or at least $1,000 every day, it's easy for me with about $10,000 realistically. So I do that every day, 4 days a week. So that's the most that I want. The question is, what do you do with the rest of the money? We're going to talk about that in the next slide. But how to trade a large account is you want 20% exposure maximum. If you have a small account, right? If you have a small account, we say the small account is what, $5,000, then no more than no more than what? So what's 20% of 5,000? It's $1,000. Then you shouldn't be spending or exposing more than $1,000 in your position. What can $1,000 do for you, right? If you trade a position that is valued at $1,000, what can that do for you? If you're in calls, you can make a lot, but there's high risk. If you're doing debit spreads, then you can make roughly $1,500 a week from that 1,000. Yeah. Or you can double that money every week. I think I've taught in my class how to make $500 using $500 3 times a week. Barbara, you've taken my class, right? Where's Barbara? Barbara is there. Is she there? Are you able to talk?
Oh, I'm sorry, Eddie. No, I have not taken that class.
Okay, then it's a different Barbara. Sorry.
Yep.
But yeah, I was going to say that. Yeah, if you've taken my class, then you will discover how to using $1,000. You can actually $1,500. You can make $1,500 every week. So
Are you
that
talking
is
spread, like debit spread? Debit.
yes,
Okay, I see.
yes, or even credit spreads, any kind of spreads. There's several ways that you can make money safely without using the calls and the puts. So I teach how to do that, and that's a growth area for a small account because I do actually like to specialize on or focus on people who have a small account, and the idea is to help them grow that into like 25, 30,000 so that this PDT, you're all familiar with PDT?
Yes.
Yeah. So PDT, once it's not an issue, and how to stay above that $25,000. So I think we've been very successful on that. The motivation is just grow slowly, grow consistently, always pay yourself. Yeah. That paying yourself every Thursday or every Friday is just humongous. That is huge. It gives you such motivation that, on Monday you feel like you're just waiting for the bell, right? So even with the $5,000, you can still make plenty of dough. But how do we trade a large account? So 20%. And then because you have the capability to go in large, especially on spreads, which I do not recommend again, but there are those who have a lot of experience and they're now trading 5 spreads or 10 spreads. Uh, Selling 10 spreads, credit spreads, you actually need about $5,000. That's the exposure. So you're not even using that $10,000. You're exposing $5,000. But if you're crazy enough, like me, and you go up to 20, then that's when you're talking about the $10,000 of exposure. So you want to scale in. The right way is not to buy or to sell into the position all at once. Don't do that. right? Don't do that. In fact, what you want to do is you want to scale in slowly. Here's how I do it. I don't even start with 5 in the morning, right? Whatever time I start trading, to test the waters, I will sell 1 or 2 credit spreads, right? So what's 1 or 2 credit spreads? The exposure there, max loss is $1,000 minus how much premium I receive. Can my account, uh, withstand that kind of pressure? Absolutely. So there's no pressure whatsoever on me personally to make a rash decision based on, say, 1 spread or 2 spreads. So let's talk about 1 spread. Maybe I'm risking $500 total exposure on 1 credit spread on a 5-point wide spread. And you collect $1 and it starts going badly. It starts going, really weird. Those are the times where you can afford to even go 1x stop loss, right? 1x stop loss. A 1x stop loss simply means that your stop loss is 2 times the amount of premium that you received. So if you receive 80 cents, your stop loss is 160. If you received $1, your stop loss is $2. Maximum stop loss on any spread, any position is $2.50 on a 5-point wide. That's basically half the width of the spread. We go into more detail on that in class. So for me, on a large account, sometimes 1x is too much. Let's give you an example. Let's say I have 10 spreads that I sold in the morning and I received, say, $1.20, right? $1.20. $1.20 means that I received $1,200. What's my stop loss on that? If I were to use the 1x rule, now help me out here in the chat, what would be my stop loss? I received $1.20 on a spread, credit spread. What is my stop loss using the 1x rule? I'll give you a tip here. It's the, two times the premium received. What's the answer there? All right. 120, 240, right? So 240 would be my stop loss. It means that if my stop loss was triggered, then I will have lost $1.20, yes? And if I had 10 spreads, then you can do the math there and you will discover that $1.20 times 10 is more like $120 on each spread times 10, that's $1,200. That is 4 figures, 4 digits. I am not in the business of losing $1,000. That's a lot of money. You with me so far? So even if 1x is the rule, on a large account, that rule changes, and I change that to a half x, 0.5x. So instead of my stop loss being $1.20, my stop loss would be more like $1.80. Right? Is that right? 120 plus 60. Yeah, 80. So that means that my max or the potential loss there, maximum potential loss would be just that 60 cents extra, right? So 60 cents is the same as $60 times 10 spreads. That would be $600. That's more my kind of I can take that. I can take that. So here's the rule. Once you have a big account and you're trading more spreads, your stop loss cannot be the same as when you were trading 1 or 2 spreads. Make sense on that? You can't continue with that same mantra of 1x. 1x is too big. You're drawing your account too much. So don't try to lose $1,000 on any one trade. It's the same, follows the same principle to where that I say you don't need to lose more than $500 to know that you're dead wrong. Yeah. And if you're worried about losing more than 500 and losing that much money, it means that your position size is too big. Remember, we go back to where we say that position sizing is a problem. It's a huge problem all across the board. So Go down in position size. Don't try to recover that immediately. In fact, you might want to just go back to one spread, right? Forget about the 10 spreads, for some time. Let's see.
Eddie,
Go ahead.
are verticals and spreads, is that the same thing?
They're the same thing, just different
Oh,
names.
okay.
Yeah. Just some people call them vertical spreads. Some call them, they're a little bit more defined. They will call them debit spreads or credit spreads. Some people will use the words like bear spread or bear put spread or bear call or stuff like that. All fancy names.
Okay. Are you able to do those on a daily basis, or does it depend on the volatility of the market or the price of contracts?
Mhm. That's all I do every day.
Mm.
Yep, every single day I sell spreads every day. Yep.
Do you still buy calls and puts or not too
No,
much?
not too
Hmm.
much. Not too much. In fact, I was just looking at one of my accounts, and for the last 2 or 3 months, I have not sold a single call or a single, sorry, I've not bought a single call or a single put. They have all been spreads. So you're going to discover that this is a really powerful thing, D. So next week, I think when we meet is the first time we're going to be we're looking at that, and you're going to be discovering that it's a much safer way to do it. Here's the rule of trading. Once you find your edge here means that once you find a way that you're making the money consistently and that you're not exposing yourself more than you need to, so you're managing the risk, and you more than likely have a lower rate of return, but you have a more consistent rate of return. You will discover that that's the better way. You want to remove stress from your trading. And the way to remove stress is by managing the risk right out the gate, not later, before you start the trade. So calls and puts are they have a higher risk profile than spreads. So we're going to discover how that is the case. I know I'm having you part of your homework right now is to practice those calls and puts, but that's the foundation. We're going to move out from there very, very quickly and go into more scalable trades where you won't even need. I think I remember some of the trades that you and I were talking about. They require a lot of capital, in my opinion, a lot of risk.
Yes. Yes.
Yeah.
Yes.
And we're going to fix that. We're going to figure out how not to use that much money, but still make decent enough money, right? That's the
Mm.
point. Yeah. We want to figure out how do we put $1,000 every week in our pocket. Let's start there. Yeah. Once we can figure that out and we can do that safely without spending a whole lot of money, then that's the better way. And when I say a whole lot of money, it means that we are not risking a lot. Okay. So this slide over here is just talking about 20% maximum. And in the next slide, we'll talk about the rest of the 80%. So if you're selling spreads, and a lot of you know how to sell spreads, if not, you're on the way to learning how to do that, then make sure that you're targeting good enough premium. When you have a higher premium, then you have more choices, you have more flexibility on how to manage that trade. Right. So I try to go for at least 75 cents to $1.25. $1.25 is actually very hard to do, believe it or not, because you have to be closer to the money and you have to be really, really sure. So since I don't have a crystal ball to tell me what way the market is going, I tend to be more cautious, more risk averse. So I'll collect a little less premium, somewhere in the $1. If you're a member of my Discord, you will notice that we pick up usually a lot of 75 cents to 80 cents, 85 cents. Yes, I do have a Discord. So that's good enough premium for us to manage that position well, usually within about 45 minutes to an hour. That's my target time in trade. If you're 2 hours in a trade, usually it's not going very well. Yeah, you're sorting bullets. So plenty of discussion for that. And then the target exit, this is second to the last bullet right here. We're targeting 10 cents or better. Better here means that if it looks like you can pick up 5 cents instead of buy back for 5 cents instead of 10 cents, go for the low amount, right? But 10 cents generally is a good number. Why is it better than 5 cents? I'll tell you why. 5 cents is harder to get out of unless you're very, very close to the end of the day and it's going to, it's likely to expire worthless. And one of the reasons that even a lot of people don't know, they just look at the 5 cents. Here's how the platform works. When the price of that security reaches below 5 cents, even if it's 0.025, that's a very common number. Guess what? The system just lists it at 5 cents. This was a tip that was given to me by somebody at Thinkorswim. That's just the way they do it. So if you put in a buyback order for 5 cents, guess what? It's probably not going to get filled your chances of getting filled are very, very small. But if you put it at 10 cents, it goes in an instant, right? Because it's priced, it's well priced. There's two prices that you need to be aware of. There are actually three of them. I'll make that four. There's the zero, which means it's worthless. There's the 0.025 or 0.250. You will never ever get that. There's the 5 cents. You can get that, but it's going to sit there, right on top of your price for a really long time. And then there's 10 cents, which, no, before we go to the 10 cents, there's the 0.07. That's the number between 5 and 10. Again, that's a very difficult space to get filled. 10 cents, that's when you start getting filled fairly quickly, 10 or 15 cents. So there's a trick. So what I do with that expectation, with that knowledge in mind, I set my expectation and say that whatever I sell my spread for, I'm just going to target 10 cents. Make it easy on myself. Why sit there and try and argue with 5 cents? Right? Don't do it. Yeah. Don't argue with 5 cents. Let them have it. Market's going to be open tomorrow. Yeah. It's going to give you that opportunity. So try and target an exit at 10 cents. Sometimes I will buy back at 20 cents, 30 cents. It just depends on how the market is going. Here's an example. If I pick up a spread for $1 premium and now the value of the spread is say 30 cents, 35 cents, guess what? I'm more likely to close the position, even knowing that it's going to go to zero or it's going to go to 10 cents. Don't care. Why? Because I want to get out, especially if I've been there for about 30 minutes, then I just move on. I don't need to make my money work harder for an extra $50. Does that make sense? So your peace of mind is much more valuable than you stressing out and getting a headache for another 15, 20 minutes. And then market's going to shake and you're going to eventually just say, man, I need to get out now because it looks like I'm going to lose this bird in the hand. So what I normally would do is just go and let it go once it has hit my target profit, which is usually 50%. Yeah. 50% target profit. How do you calculate 50%? If you receive $1, 50% would be, I'd be getting rid of it at 50 cents or 40 cents. Yeah, that's an example there. So last but not least over there, don't be a hero. Buy your spreads back. That simply means that if you're going to let them expire, two things are happening. One, you are super confident that is actually going to happen, that they're going to expire worthless. Second is you're going to be in front of your computer for 6.5 hours, better be making some really good money. Yeah. So something that you could have achieved in 1.5 hours or 2 hours early in the morning. Why do you want to work for 6.5 hours for the same thing? It doesn't make sense to me. So no, don't be a hero. Just do it. Buy your spreads back, move on with your day, go golfing, go gardening, whatever it is, and make better use of your time. Otherwise, if you only made, I'll give you an example here. If you only made, say, 75 cents, uh, and you sold two spreads at $150, right? So if you spend all day long looking at your computer for $150, uh, that means that you got paid about $18.75 an hour. Yeah, that's not good. That's not good. Instead, why don't you pay yourself 150 divide by 2, $75 an hour. Get out. Or actually not 75, since if you bought it back, say you sold it for 75 and you buy it back for 20 cents, means that your net is 55, right? So 55 times 2, if you have two spreads, $110 in 2 hours. I think it's a much better deal. So calculate what your time is worth, what your stress, the opportunity cost and that stress, because that's huge. And the risk factor, the fact that a good trade, actually for the single most important reason you should buy back those spreads is because we know that S&P 500 can turn around, and it does every single day, and it can turn around against you. A position that was good in the morning or good one, 20 minutes ago, can become bad in a matter of minutes. So that's probably the single biggest reason you should just be in the habit of buying the bag. Questions on that? All right, one more slide, and then you guys can go home. So we talked about how to trade 20% of your account, which is basically that's your bread and butter. This is what you use to pay yourself. This is what you use to grow your account. What should you be doing with the other 80%, since you're not trading it? And we do not recommend you trade the other 80% in your account, right? What should you be doing with it? There are lots of schools of thought on what you can do with this. And since I'm not a financial advisor, by the way, this is for educational purposes only, there's plenty of stuff that you can do with the other 80% of your portfolio when you have a large account, right? When you have a large account that that can still give you money, because your wealth building tool is the money that you have inside of your account. So you want to invest in safe haven instruments. I've got quite a few in mind, but I don't give financial advice, especially on this forum over here. But I can give you some examples. Some money market funds that are yielding 5% or better. That's really low compared to what the other 20% of your money is making, but it is better than what your savings account at a regular or traditional bank account. Even some of the online banks these days, they're down to like 4.6%, right? So you can most brokerages, Schwab, Fidelity, E-Trade, they have money market funds or sweeping accounts where you can move your uninvested cash, right? That's one. You can pay in some dividend paying ETFs, not stocks, by the way, not stocks, dividend paying ETFs, right? So you want to, again, not expose yourself to, don't expose yourself to any more risk than you need, right? You're already doing well in 20% of your account. It's giving you money. It's growing the portfolio as a whole. So don't let these other 80% be aggressive. That's where you slow down a little bit. When you go to your financial advisor, they'll probably present you with a pie chart that says your portfolio needs to be in like 4 or 5 different things, usually 4, growth and income. Forget what the other 2 are, bonds, maybe, whatever. But you can do this yourself. And you can join if you're a member of the alumni for Options with Eddie. We talk about this on Thursday nights, where we talk about how do you invest the 80% that you're not day trading or swing trading. Something else that you can do is you can have 1 or 2 leaps in ETFs, again, not stocks, right? I have a very, very radical view on leaps and how to do leaps the right way. And again, based on my experience and performance, I have found that ETFs will outperform stocks when you're doing the leaps. Then you can also invest in other traditional businesses. A lot of people like real estate. They like collecting that. Just make sure that it is not giving you more headache than it's worth. One of my friends just hit multi-millionaire status and went into real estate, and she is talking about how much of a headache she now has based on the real estate. So it's turning out to be not exactly the blessing that she thought it would be. Tenant issues, uh, uh, building issues, breakages and all that kind of stuff, breakages from older equipment inside the apartment, repair. Remember, when you're a tenant, when you're leasing a property, and maybe this is one of the reasons that a lot of people will rent rather than buy their homes, is that faucet breaks in between the wall, not your problem. Who do you call? You call the owner and say, or the building maintenance people, and hey, I got a leak. You guys need to fix it by the time I'm done with breakfast. Stuff like that. Yeah. And repairs are not they're not cheap. Sometimes it takes 4 or 5 months of rental income to fix one problem. So that's just an example. It's not all rosy when you hear people investing in real estate. Uh, you need to go in very, very carefully. We've talked about that in one of the power evenings about how to do some of that safely. You can also go into REITs. There are so many other instruments that you can choose. And this is a topic here that can go on, on and on and on. But we'll let it be at that. Any questions? Any burning questions on that? All right, good deal. Well, thanks for showing up. If you want to work with me, you know how to get me. Basically, you go to optionswitheddy.com. That's the best way to get a hold of me. Actually, I should probably type that on the screen. Let me do that one more time. Let me share my screen again. Am I sharing the right screen? Yeah. So there we go. Options with. That's the best way to get a hold of me. Just go to that website, optionswitheddy.com, and we will help you out.
Eddie?
Options. Yes.
Is all your classes at night?
Not all of them. Sometimes I have students from different places in the world. For example, I have a student in Japan who I think there's a 12-hour difference, I think. So it's a really crazy. She would have to wake up in the middle of the night to come to class. Not the best time to start learning stuff. So if you, what state are you in? Or what is your time zone?
Central.
Central?
But
Yeah.
I'm gonna be working second shift, so I can like do trading. So
Mhm. So you're looking for a daytime class.
right.
Hit me up. Let's talk about it. Let's figure out something that that can work out for you and me.
Okay,
Yes, yeah, I'm flexible. I can, because this is all I do. Okay. Uh, in support of my students and all that. So I will meet you where you are, which means that if you have a special case, you work during the day or you work at night, then you know, if you need to find an hour, I can find an hour, right? Can you find an hour or two
oh
every
yeah,
week? Yeah, I think you can. I think when you have the passion to do it, then yeah, you'll make the time where there is none. So not an issue there. Just hit me up. Let's talk about it. Let's see how we can help.
awesome, great.
Sure. Yep, that's the website. I am sharing on the screen over here, optionswitheddie.com. And if you're watching this for the first time and you want to figure out whether this is for you, go and click that quick meeting and just choose a time. Let's figure out whether you're a good fit. I've got plenty of times available. Usually Tuesdays and Thursdays. Pick a time. If none of these work for you, then don't be shy. Just hit me an email with an email. Do I have my email here at the bottom? Yes. So way at the bottom, info@optionswitheddie.com. Just send me an email right there, and we'll connect. We'll help you out. But it's a simple one-page thing. It tells you exactly what we do, what you're going to learn. This is just some of the things that we're going to figure out. And the format is basically 2 times a week for a month. That makes 8 sessions, sorry. And then I give a lot of homework. So, but you don't have to turn it in. That's up to you. Let's see what else. Yeah, just go read it. Yep. Then when you're ready to sign up, push any one of the blue buttons that says sign up or pricing and sign up. It's real easy. It's a one-step process. Okay. Cool. I don't have anything else to share. Any other questions today? No questions. All right. Well, I wish you all a very great Saturday, and thanks for joining Options with Eddie. Good night.
Thank you, Eddie.
Thank you, Eddie.